Welcome friends, welcome to Bankers Plus Academy video. In our foreign exchange simplified series, today we are going to discuss FCNR-B accounts. FCNR-B means Foreign Currency Non-Resident Bank Scheme. It's a deposit scheme where the exchange risk is borne by the bank. The depositor does not have any exchange risk. He is depositing the amount in foreign currency. He is getting the maturity amount also in foreign currency with interest in foreign currency at the contracted rate. Let's see what are the features of foreign currency non-resident accounts. Who can open FCNR accounts? FCNR accounts can be opened by NRIs and PAOs, that is, non-resident Indians and persons of Indian origins. Deposits can be opened in any permitted currency. Though deposits can be opened in any permitted currency, generally banks have restricted the number of currencies to 6 or 7 major currencies. The deposits can be opened with fresh remittances from abroad or conversion of NRI accounts. FCNR deposits can be maintained in the form of term deposits or fixed deposits only. That means you cannot open FCNR SP account or FCNR current account. It's only in the form of term deposits only. Now, joint accounts. Joint accounts can be opened by two NRIs or PAOs. Joint accounts can also be opened by NRI or PAO with a resident close relative on former or survivor basis, like in the case of NRI accounts. That is, joint accounts with resident close relatives is also permitted, but it will be on former or survivor basis. Here, during the lifetime of the NRI or PAO, the resident relative can operate the account as a power of attorney holder only. So that's the difference. Now the period. The minimum period for opening an FCNR account is 1 year and the maximum period is 5 years. That means you can open a FCNR account for 1 year to 5 years. Therefore, if the account is closed within 1 year, no interest is payable to the depositor. Not only that, banks at their discretion may levy penalty to cover their swap cost also. So, on premature closure within 1 year, not only that the customer will not get any interest, the bank may also charge the swap cost. And if the deposit is closed after 1 year, that is closed prematurely after 1 year, normal penal interest will be charged. It differs from banks to banks. On maturity of the deposit, the depositor can renew it, or it can be converted into an NRI deposit. It can be converted and continued as a NRI term deposit. Here, NRI deposit can also be converted into FCNR deposits. The amount in FCNR deposits fully repatriable and the interest is not taxable, like in the case of NRI deposits. Now, coming to loans against FCNR deposits. Loans against FCNR deposits can be granted. Loans can be granted to account holders or third parties. Rupee loans in India can be granted to account holders or third parties. Similarly, foreign currency loans also can be granted abroad to account holders or third parties, subject to the usual margin norms, which is decided by the respective banks. Now there is no ceiling on the quantum of loan. Again, it's granted subject to the margin norms. The interest rate on such loans is decided by the individual banks. What happens if the depositor is coming home permanently? When an NRI comes home for permanent settlement, the existing FCNR-B deposit account may be permitted to run till maturity. Till maturity it can be run. It can be continued to run. At the contracted rate, at the originally contracted rate. On maturity, it should be converted into resident deposits or RFC account. It cannot be further renewed as a FCNR deposit. Either it should be converted into a resident term deposit, domestic deposit, or RFC account. RFC account means resident foreign currency account. Now when the depositor becomes a resident and it is matured while he is in India after permanent settlement, at that time the interest received by the depositor will be taxable. So that's an important point. If you liked this video, please subscribe to our channel Bankers Plus Academy. Thank you.